Well, welcome to this video. Again, this video is all about financial analysis, and um, I consider this to be probably one of the most important skills a manager needs to possess. You need to be able to look at statements, look at reports, understand what they tell you, right? And then problem solve. How do you fix things? The second most important skill is to be able to communicate this in both written and verbal form so that others can understand the issues. It's just a skill that becomes so critical in the business world, and many folks don't get an opportunity to understand how to analyze data. So, first thing, let's talk about income. Sustainable income refers to income that continues, right? We expect this kind of income for the foreseeable future. But there are, from time to time, there are items that happen that we need to account for that are irregular, right? So there are two items we want to talk about. There's something called discontinued operations and other comprehensive income. So we'll start talking about discontinued operations. Before we get though, these items are reported on the financial statement, but they're reported net of income. So what that means is we determine the profit or loss, we subtract the tax, and then that is what is the line item that's reported. So here we have a company of $800,000 in income. We discontinued and sold an unprofitable division. The loss from this operations, net of the $60,000 taxes, was $140,000, right? So then the loss on the disposal of the chemical division, net of $30,000, was $70,000. And we're assuming a 30% tax rate. So how do we report this? So here we have our line items, right? Here's the discontinued operations. Here's the loss from operations, $140,000. Loss from the disposal, $70,000. So the total loss, right, of this discontinued operations, $210,000. So you can see that the income from continuing operations was $560. Subtract out this loss, so the net income of the company, $350,000. What you'll note here is there's actually 3 times we're paying taxes, not on the same money, but there's taxes on continuing operations. And then there are the tax consequences of each one of these discontinued items. Comprehensive income, this is just any changes in equity except those resulting from investments and distributions. So what other kinds of things fall into this example? It could be something like an unrealized gain or loss on some securities that you own, right? So essentially what they're saying, there's certain kinds of income that bypass net income. And they're just reported directly as adjustments. So accounting standards require companies to adjust most investments in stocks and bonds up or down at the end of each accounting period. So we purchased IBM stock for $10,000. At the end of the year, it was still holding an investment, but now the market value was $8,000. So how do they account for the $2,000 unrealized loss? Well, how do we do this? Well, you could trade the security, right? Or for an available for sale security, right? It depends on how we classify the stock. If it's a trading security, right, then we have an unrealized gain or loss goes on the income statement. But if this was an asset that was available for sale, right, we purchased it essentially as an investment, then we have to show it as an unrealized gain or loss in the equity section. So back to our example, the same example. We have the market price now 8,000, right? We're required to reduce the recorded value by this unrealized loss. Went from 10,500 to 8,000, right? So we also have to assume the tax of 20%. So how do we do this? How does it show up on the income statement? If this is classified as an available for sale, right? Available sale just shows up. It's after net income. It's in this other comprehensive income site, right? So again, it's $2,500. There's a 20% tax. So that means we have a $500 tax. So it's net of tax, $298 is the total. If we have $3 million in dollars retained in earnings, $300,000, and accumulated other comprehensive loss of this $2,000, again, this illustrate just shows the balance sheet presentation can just plug it in here as this negative $2,000 for a balance sheet presentation. So again, many companies report net income and other income in separate statements, right? So we don't have to put it in one statement. Here's one where they're all combined, right? Then here's another one has a statement of comprehensive income where they have the income and then they adjust it in a separate statement, if you will. What do we do about changes in accounting principle? From time to time, companies may decide they want to change the way they account for things. FIFO, inventory reporting, is one of the most common of these. So if we change, we need to make this change, and we have to show some of the changes retroactively. So there'll be some line items and adjustments that we make over time for these changes in accounting principle. I don't want to get into too much detail here. The most important part of this video is to point out that there are things that happen in the company that are unusual. Sometimes they're referred to as extraordinary items. They are shown separate so that we can identify the going concern of the business that we consider to be going onward, and then these things that ultimately show some change in that mechanism. Because we want to be able to make comparisons moving forward between the business that's growing, continuing, and what it's going to look like next year, the year after, etc. So again, that's the end of this video. It's a short video, so I hope you got something from this different way of looking at a financial statement.